Imagine a company that manages nearly 1 billion Turkish lira in assets.
A huge amount of money.
It issues massive financial instruments, it moves mountains of cash, and it funds these really complex agricultural networks. I mean, by the numbers, it is a titan.
Right, it's handling enough money to run a small city.
But here's the riddle for you. This company has exactly 0 employees.
Oh, wow.
No receptionist, no CEO in a corner office, no IT guy trying to fix the printer. It is, for all intents and purposes, a corporate shell handling 1 billion lira.
It sounds a bit like a ghost ship, doesn't it? Or maybe the setup for a heist movie.
It really does.
But, in the world of high finance, sometimes the most powerful engines are the ones that don't technically exist in the physical world. It's entirely legal, highly regulated, and surprisingly common.
Welcome. Today we are cracking open the 2025 independent audit report of Kalkınma, Yatırım, Varlık, Kiralama.
That's a mouthful.
It is. We're going to find out how a company can exist purely on paper to move that kind of money, and, importantly for you listening, whether it made any money doing it.
This is a fascinating case study for the retail investor because it forces us to strip away all the usual noise.
What do you mean by noise?
Well, usually when we analyze a company, we talk about culture, marketing, supply chains. Here, none of that exists. There are no marketing budgets, no HR scandals, no product launches. It's pure financial engineering. We are looking at a special purpose vehicle, an SPV, designed for one specific mission.
Okay, so let's first get to know the company a little.
Good idea.
According to the report, the full name is Kalkınma, Yatırım, Varlık, Kiralama, which translates to something like Asset Leasing, Inc. It was established back on May 28, 2020.
So it's relatively new.
Yeah, and I looked up the address in the report, Dr. Adnan Büyükdeniz Street in Ümraniye, Istanbul.
That's a very standard financial district address. Lots of glass buildings, banks, company headquarters.
Right, but here's the catch. I was looking through the general information section of the audit, checking for the usual stuff factories, branches, subsidiaries. There is nothing. No factories humming with machinery, no international offices. And then I got to the employee count. The report says, and I'm quoting here, as of 31 December 2025, the company has no personnel.
And that is the zero factor. It's crucial to understand this isn't a mistake or an omission by the auditor.
So it's intentional.
Absolutely. The report clarifies that all operational and management activities are carried out by its parent company, Türkiye Kalkınma ve Yatırım Bankası, the Development and Investment Bank of Turkey.
So it's 100% owned by the development bank. No staff, no independent office. It just lives at the bank's address. It's essentially a puppet, isn't it? I mean, in the most legal sense possible.
Subsidiary is the polite term, but yeah, you've got it. The shareholding structure is clear, 100% ownership by the bank. And this explains the board of directors situation.
You mean the compensation?
Exactly. The source material notes that for the period ending December 31st, 2025, there were absolutely no payments made to top management.
Which makes sense. You can't pay a salary to a ghost. The actual people signing the documents are probably employees of the parent bank, drawing their salaries there.
Right.
I actually tried to find some diversity stats, the number of female board members, which we usually look for. But the report focuses so heavily on the financials and the lack of people that names and demographics aren't even detailed. It really just reinforces this idea of it being a legal wrapper.
It is a wrapper, but a very necessary one. Its core business is to issue lease certificates, also known as sukuk.
Let's pause on that word, sukuk. For anyone listening who hasn't dabbled in Islamic finance, how is this different from a normal bond? Why create this empty company for it?
That's a great question. It's really the heart of the matter. In traditional banking, you lend money and charge interest. Simple. Money makes money.
Right.
In Islamic finance, that idea of money making money through interest is prohibited. You need a trade-based transaction. So they use lease certificates. You need a real underlying asset.
So you can't just lend cash.
Exactly. You have to buy an asset, say a tractor or a portfolio of leases, and then lease it back to the borrower. This company, Kalkınma Yatırım, is the middleman that technically holds the title to those assets, so the whole transaction works.
Okay, that makes sense. So we should think of this company not as a factory making widgets, but more like a specialized pipeline?
A pipeline is a perfect metaphor.
Investors put money in one end, it flows through this SPV to a borrower like an agricultural company, and then the rent or profits flow back through that same pipeline to the investor.
Precisely. So it operates in the capital market sector, but it doesn't compete for customers. It doesn't have a sales team. It just facilitates deals for the parent bank.
Okay, so if we were to do a quick SWOT analysis here, the strength is obvious. It's 100% backed by a state-controlled development bank. That's a massive safety net.
It's hard to get more secure than that. And don't forget the cost structure. Its operating costs are virtually zero because, well, zero employees. It's extremely efficient.
And the weakness.
Zero operational autonomy. It does exactly what the bank tells it to do. If the bank decides to stop issuing sukuk, this company basically goes into hibernation. It has no brain of its own.
The opportunity, I guess, lies in the growth of that lease certificate market.
Mm-hmm.
We're seeing more investors looking for alternatives to traditional interest.
For religious reasons or just for diversification, yeah.
But the threat, as we see in the report, is the economic context, specifically high inflation.
Which brings us to the elephant in the room regarding these numbers.
Right. Now we can move on to our analysis. I was looking at the balance sheet, and the numbers felt a little wild. But there is a disclaimer right at the top about hyperinflationary accounting.
Yes, we need to frame this correctly before we dive in.
Okay.
Turkey is treated as a hyperinflationary economy for this period because cumulative inflation over 3 years was over 100%. So all the figures we're about to discuss are inflation adjusted under the TMS 29 standard.
Simplify that for me. Does that just mean the numbers are bigger?
It means they represent the purchasing power as of December 31st, 2025. TMS 29 recalibrates past numbers so they make sense in today's lira. It lets us compare apples to apples, even though the value of the currency has been swinging around.
Okay, with that lens on, let's unpack the balance sheet. This is where I had my aha moment.
Go on.
In 2024, the total assets were sitting at about 1.2 million TL. Tiny, almost irrelevant. But in 2025, that number exploded to 936.3 million TL.
That is a massive jump. It's not just growth, it's a complete transformation.
What happened?
The company woke up, it went from being dormant to extremely active. And if you look at the breakdown, that 936 million isn't cash in a vault. It's almost entirely listed under trade receivables, about 930 million TL.
So they're owed 930 million lira. But where did they get the money to lend out? They started with basically nothing.
From the liabilities side of the sheet, it's a perfect matching act. Under liabilities, you see issued securities also sitting at roughly 930 million TL.
Ah, so it proves the pipeline metaphor.
Exactly. They didn't have the money. They borrowed 930 million from investors by issuing these certificates, and they immediately passed that asset along to their clients.
So the balance sheet is huge, but it's balanced. Debt on one side, receivables on the other. Feels risky, though, doesn't it? Just seeing a debt number that high.
In a normal company, yes. If a manufacturer had 930 million in debt and only $1 million in equity, I'd say run for the hills. But here, the net debt is technically massive, but it's fully offset. The risk isn't really on Kalkınma Yatırım. The risk is on the companies that owe them money.
It's a pass-through risk.
That's the term. If the borrower pays, Kalkınma pays the investor.
Okay, let's look at the income statement to see if this pipeline leaks any profit. This was weird to me. Revenue, or sales, for 2025 was 129.5 million TL. But in 2024, it was over 600 million TL. Revenue dropped significantly. Should we be worried?
Not at all. You have to remember, revenue here isn't selling shoes, it's the turnover of these financial contracts. A drop in revenue implies that the volume of transactions or maybe the turnover rate was higher in the previous year.
So maybe lots of short-term deals in 2024 that matured quickly.
That's my guess. It generated high sales figures on the books, less churn in 2025, maybe longer-term holdings. But here is where it gets really interesting look at the gross profit.
I see it. Even though revenue plummeted from 600 million to 129 million, gross profit actually went up. In 2024, it was about 750,000 TL. In 2025, it's 1.75 million TL. It more than doubled. How do you make more profit on less revenue?
Margins. It suggests a much better pricing structure on the 2025 issuances. They likely negotiated better spreads between what they pay investors and what they charge borrowers.
So they did less volume, but kept more of the spread.
That is efficiency. Efficiency over volume.
Okay, moving down the list. Operating expenses. General admin expenses went up to about 11.1 million TL from 7.9 million. Since they don't have employees, what are they spending 11 million lira on? Gold-plated stationery.
Tax. The notes clarify this perfectly. It's mostly brokerage fees and registration fees for BuyST, the stock exchange, and the SPK, the Capital Markets Board. It costs money to be a public issuer. You have to pay the
You
regulators.
can't escape the bureaucracy costs.
Never.
Okay, so after paying the regulators and brokers, what's the bottom line?
Yeah.
Net profit for 2025 is 304,589 TL. In 2024, it was 148,656 TL.
So despite the revenue drop, the net profit doubled. Now, 300,000 lira might sound small for a company handling $1 billion in assets. You might ask, is it worth it?
That was exactly my question. $1 billion lira risk for 300K profit. Seems like a lot of work for a small paycheck.
But remember the structure. It's an SPV. It's not designed to hoard profit. It's designed to pass profit to the investors. If this company made a massive profit, say $100 million, it would mean they were shortchanging the investors. The fact that it's positive and growing is the key.
Right. It covers its costs, pays its taxes, and keeps the lights on.
Exactly.
Let's talk cash flow. For a retail investor, seeing cash on hand is always reassuring.
And the company is cash positive. Cash and cash equivalents increased to 1.95 million TL, up from 1.13 million in 2024. It's a healthy buffer for those administrative fees we just talked about.
Okay, that brings us to the most important question for me. Who are these borrowers? Where does the money actually land? The footnotes name names, which I love. It makes it real.
Yes, this is where the financial abstraction hits the dirt, literally. The 930 million TL portfolio is split. The biggest chunk, about 600 million TL, is with a company called Tarfin A.
Tarfin, I've heard of them. They are that agricultural fintech company, right? Helping farmers buy fertilizer and seeds on credit.
Correct. And this is a massive insight for you. If you are a retail investor buying these specific lease certificates, your money isn't just sitting in a vault. It is flowing through this SPV into Tarfin and then out to a farmer in Anatolia to buy seeds for the next harvest.
That is really cool. It connects high finance to the actual soil, makes the investment feel tangible. And the other chunk,
About 330 million TL is with Vakıf Financial Kiralama, a major leasing player. So that might be funding machinery or vehicles for small businesses.
so no physical investments for Kalkınma itself. Their investment is just buying these portfolios.
Exactly. And regarding the future outlook section, usually you get a long CEO letter about vision. Here, the commentary is in the numbers. The huge jump in assets tells you the parent bank is using this vehicle much more aggressively. They are bullish on this mechanism.
Let's check the financial ratios and equity. Shareholders' equity increased to 1.67 million TL. It's still a tiny sliver compared to the total assets.
It is, but look at the paid-in capital. It went from 50,000 TL to 250,000 TL in June 2025.
That's a 5x increase. Why bother? 250,000 TL is still small change for a bank.
It's a capital injection. The parent bank put more skin in the game. It's a regulatory thing, but it also shows commitment to keeping the entity capitalized enough to handle the larger deal flow. It builds confidence.
I want to dig into the footnotes. Note 12 talks about related party transactions.
This is critical. We know they have 0 employees. So who does the work?
The note says they paid about 2.2 million TL to the parent bank for services.
There's your answer. They are renting the bank's staff, its IT systems, its legal teams. It's an incredibly efficient model. Why hire a CFO when your parent company has a whole department of them?
Right, you just pay a service fee.
It confirms that puppet status, but in a way that maximizes efficiency.
But who checks the checkers? Who audited this ghost ship?
The report was audited by Günibamsın's Denetim, which is a member firm of Ernst & Young, so a Big Four auditor.
And the verdict,
It's an unqualified opinion.
which always sounds bad to the layperson. Unqualified sounds like they don't know what they're doing.
Laughs. I know the terminology is confusing. It's the opposite. In auditor speak, unqualified means clean. It means without reservation, no red flags. For an investor, seeing a clean bill of health from EY on something this complex is very reassuring.
It means the pipeline isn't leaking. One last thing I noticed in the tax section, the corporate tax rate. It's mentioned as 30% for financial institutions in 2025.
Yeah, that's a significant chunk. The government increased the rate for banks and financial institutions, so that 30% bite is reflected in their expenses. It makes that net profit doubling even more impressive when you consider the heavier tax environment.
We've covered a lot of ground. The balance sheet explosion, the profitability, the agricultural connection. So what does this all mean for the listener? Why should you care about a company with no employees?
I think if we summarize it for the retail investor, Kalkınma Yatırım is a safe, boring, necessary cog in the financial machine. It doesn't get rich through innovation. It gets by on transaction fees and spreads, but it allows you to access asset classes like agricultural credit that you couldn't easily get to otherwise.
So the bottom line is, if you see Kalkınma Yatırım on a lease certificate, You aren't really lending to this empty office. You are essentially lending to the underlying assets, like Tarfin's farmers, with the structural backing of the development bank wrapping it all up.
It is a layer of structure that lets capital flow where it's needed. It's efficient, it's audited, and in 2025, it was highly active. It tells us the development bank is serious about using this tool to fund the economy.
I want to leave you with a final provocative thought. We just spent all this time analyzing a company that manages $1 billion lira with 0 human employees. It's just legal contracts and a parent bank.
Yeah.
In an era of AI and automation, is this the future of business?
That's a great question.
Are we going to see more of these 0-employee billionaires?
It really raises a profound question about what a company even is. Is it people, or is it just a legal protocol for moving value? As AI agents get better, the parent might not even be a bank anymore, but an algorithm.
Something to mull over. If you enjoyed decoding this financial puzzle with us, smash that like button and subscribe.
And share this with a friend who thinks accounting is boring. Prove them wrong.
Evaluate our channel membership if you want to help us keep making these deep dives. And if you're feeling generous, you can show support directly with super thanks.
Thank you for spending your time learning with us today.
See you in the next deep dive.